Hey everyone, it's PJ Patterson here for Market Update for Monday, the 26th of October. Hope you are enjoying this reversion back to winter weather. It's just crazy how cold it is at the moment here in Sydney, but hopefully this will be the last gasp of sort of winter weather, and then we'll be on to warmer and much nicer times. Only, 2 months to Christmas now, which is equally crazy that we are at the end of this year, and a crazy year it has been. I'm sure we're all happy. We'll all be happy to see the back of it when we finally click over to 2021. Anyway, top three things today are the US dollar, oil, and going to talk a little bit about the election, which seems to be driving a lot of what's going on. So, first thing, and the US dollar's featured a lot lately in these updates, and for very good reason, because it is absolutely in a bear market right now, but we've seen the dollar showing a little bit of strength in the last couple of weeks. It is, again, still trending lower, but we often will see counter trend moves in something. But the key thing, and I just want to revisit this table once again, that I've been showing quite a bit, are the correlations between the dollar and various asset classes. So over a longer term, 90 days, 120 days, we see the correlations for most asset classes are quite strong. But there's one in particular that I want to focus in on, and I'll get to that in a second, and that's oil. But just before I do that, I did want to go to slide. Let me see here. I'm just going to go back up to a couple of earlier slides here. Yeah. So this is just a representation of what I've been talking about with the US dollar. You can see here, back in sort of May, June, July, it was a little bit up and down, but it was clearly going sideways. And that's that period back in sort of late May, late March, early April is when the dollar peaked. And it has subsequently rolled over and has really fallen sharply. It's going to continue to fall almost definitely. And the catalyst for that is going to be post-election, whatever bazooka of the fiscal stimulus the government in the U.S. rolls out. And I think it's going to be big, whether it's Trump or whether it's Biden. It's not going to really matter. They're both going to spend an absolute shit ton of money. And that's going to further or cause the further demise of the US dollar. So that is going to underpin other things such as commodities. I'll just come back to the Treasury. Commodities, we've seen most of the commodity complex, wheat, soybeans, corn. Here's the CRB index, just moving up left to right. This would be the inverse, really, if you inverted this with the US dollar chart, as you can see from June right through to now, basically October. It's been almost straight up. You go back to the dollar chart. Sorry, I'm going the wrong way. There we go. Dollar chart, June, right in here through to now. Dollar straight down, commodities almost straight up, with one exception, and that's oil. I'm just going to talk about oil real quick before I get to that. Though the Treasury yields, we're at a very interesting spot here with U.S. Treasuries in that we've seen Treasuries climbing since sort of August back up to their sort of a top end of their range, which their long-term upward trend, if it breaks, this is the 10-year, if it breaks about 1.03%, we're going to be back into a bull market for treasuries, which would be interesting because that'll be signaling rates are rising. So the reason this is circled here is because the last time we saw a big spike in treasuries was back in June. And of course, it fell over fairly quickly. So watching this with great interest because I think that we're going to see treasuries roll over here, but if they don't, that's going to be a sign of interesting things to come down the track. So let's talk about oil. Just back to, where were we? The correlations. You'll notice here that oil has not been particularly strongly correlated with the dollar over the last 90, 30, and 15 days. In fact, it's very much uncorrelated to the movement in the dollar. Over the longer term, though, obviously it moves a bit more strongly with the movements of the dollar. But this is why this is interesting. And it's because oil, obviously, is one of the main driving commodities for the world economy. And the fact that oil has been fairly uncorrelated to the movement in the dollar is interesting. But we have a feeling, or I think, that it is beginning to shift, and we're going to see this movement now of the oil price higher, and that's going to should show up anyway in this US dollar correlation table. We should start to see over the 15 and 30-day period that oil will get more correlated to the dollar, and it'll be negatively correlated because effectively what that's saying is, again, that as the dollar moves in a direction up or down, that the other asset that you're comparing it to is moving in the opposite direction. So again, as the dollar falls, we should see oil rising. It's the same with gold, the same with Bitcoin. That's what BTC stands for, the commodities, and of course the S&P 500. So oil is going to be super interesting. Now, one of the things driving oil is my good friend volatility. So oil volatility, and the oil volatility index is the OVX index. And as you can see, oil volatility has been elevated over the past, few months. Oh, let's get a better chart there. Over the past couple of months, oil volatility has been quite high. And we need to see oil volatility continue to fall. It has been falling, but we need to see it continue to fall. That's going to start to really signal that something is truly shifting in the energy markets. Now, interestingly, in quad four, energy gets absolutely hosed. And you can see from various energy ETFs, and of course the oil price, that energy's been totally caned this year, like really badly caned. And one of the things that I want to just quickly show you, if I can get back to there we go, is first of all, a earnings table. Let me just get to that slide. So we are in earnings season, and I'm highlighting this right now because I want you to just draw your attention to the energy companies. Now, we've only had 6 of 25 energy companies reporting earnings at this stage. I don't know which ones have reported just yet, but clearly we're going to see a negative number here. I just don't know if it'll be negative 80 or it'll be something this side of negative 80%, but that is really, really bad earnings growth, like negative 80%. The only one that's beating that is the industrials, and again, only about a third or so of the companies in the industrial section of the S&P 500 have reported, but that's pretty bad, like almost negative 100% earnings growth. Like that is horrendous. Other classes have noted the consumer discretionary, which is no surprise, but again, we've only had about a little bit less than a third. Actually, that's probably about a quarter, actually, of the S&P, just around a quarter of the S&P companies have reported. But we'll get more data on that in the coming, probably this week, and then the following week we'll get more data yet and see where we end up with earnings growth and sales growth. So that's that. One other thing I want to mention about the oil and treasuries and U.S. dollar, I'll just go to this other slide here real quick, is something that I probably have talked about a little bit before, but I haven't necessarily highlighted it too closely, and that is the commodity futures trading positioning, and this is for non-commercial positions. So these are these would not include the big companies that buy and sell commodities because they're actually going to take delivery. These are like speculators and traders and such like. And one of the interesting things that's happening right now is the things that are highlighted here are things that have a plus or close to a standard deviation of plus or minus 2. And that's important because if you're familiar at all with statistics, and I did some statistics in college, but I wasn't great at it. But anyway, standard deviations are the further you go away from sort of that the event that you would expect. So one standard deviation is sort of gets the probability or possibility of that happening is it's possible, but it's less likely. 2 standard deviations get you even more out there. 3, 4, 5, 6 standard deviations are sort of those events that are like black swans, things of that nature. So they're extremes. So the further out you go away from sort of the mean or the middle of a curve, let's say. And so once you get to 2+ standard deviations, these start to signal, and we know this because it's just historical, these start to signal that we're at extreme positioning. That's all I'm really trying to say here, is that 2 standard deviations plus is extreme positioning. So what we're seeing particularly in the treasury market, people are making big bets on treasuries, basically now going to be entering a bull market. This is why they're shorting them. In actual fact, we should be taking the opposite of the trade, which we actually are on the opposite end of this trade, and because oftentimes the majority is wrong, quite frankly, and these positions tend to correct themselves. So they don't stay that way for a very long time. They tend to come back to being somewhere more akin to maybe 1 standard deviation or less than 1 standard deviation, something like that. So that's quite interesting. Another thing to note here is, where was it? The U.S. dollar index. It's not an extreme position, but certainly a lot of people are short the U.S. dollar. That's about all I think I wanted to show you there. But anyway, lots of information. This is just part of the puzzle. Things that we use to highlight extremes that tell us maybe something is going to be changing, or maybe we're at a what's the word I'm looking for? A turning point in something. Now, the other chart I quickly wanted to show you was the implied volatility table. And I've referenced this table before, but just to refresh your memory, when you see an implied volatility premium, it means that there is complacency in the market, and people are, it means that, sorry, the other way around. It means there is concern in the market. People are hedging their positions. They're buying put options. They're concerned about the market moving higher. Again, they're usually wrong at the turn. And commensurately, when there's an implied volatility discount, it means that there's complacency. So premium means that there's a lot of concern. Discount means there's a lot of complacency. Now, usually, just to put this in context, what happens is when you start to see these big implied volatility premiums, it's usually after something has moved lower. So people buy protection after the horse has bolted from the barn. So they're doing it after the fact. And that's one of the reasons why you get to extremes, because you start to see a correction in something, it builds on itself, and then people decide they need to buy protection. That's why you get these implied vol premiums, because they're paying a premium to get the protection. Again, often traders are wrong at the turns. So one of the things, again, that I look at that helps me with positioning and understanding what the markets are doing is look at these premiums and let that guide, along with things like the CFTC information, let that guide me to making a decision about buying something, selling something, or maybe trimming a position or adding to a position, that sort of thing. One of the things I want to highlight here is that in a couple of key markets, the S&P 500, there's an implied vol premium. It wasn't as high as the previous day. This is from October 23rd, but there's still an implied vol premium, which tells you people are putting protection on now because the S&P 500 started to have corrective days. Other markets that are kind of interesting, Japan and emerging markets in China all have an implied volatility premium. Again, people are concerned about those markets having dropped and are now buying protection. Commensurately, we did have, it was interesting, we had discounts in a number of the tech shares a couple weeks ago, as you can see here. Unfortunately, we don't have the data more than a couple weeks back here. There was 1 month ago, but anyway, you could see where they're very, very tiny premiums. And at one point, what am I trying to say? At one point, we saw discounts across most, if not all, of the big cap tech companies. Again, that was sort of a warning sign that we were reaching a crescendo in the tech current run of tech shares. Anyway, again, this is just one of those metrics that is useful to understand and useful to use in trading activity and positioning. Now, finally, I just want to talk about the election. So we know, or in case you didn't know, the election's on November 3rd, which of course is Melbourne Cup Day. And right now, I think it's a coin flip. I mean, I know there's polls and things like that that are suggesting that Biden has a lead, and that may very well be very true. I don't know what the standard deviation or error in those polls are, but this is exactly what was happening in the last election, where Hillary Clinton had quite a strong lead. It wasn't quite as much as Biden's lead at this stage of the election, but she still had a lead, and many people and market or election commentators, I should say, were prognosticating that she was going to win the election. And of course, Donald Trump came out of nowhere, seemingly, and won the election. Now, I think the reason really that I've highlighted it today is to simply say that over the course of the next week, we're expect to see a lot of volatility in the markets. I know the volatility numbers, and I'll just go back to the interactive broker screen and just refresh vol. We are seeing declining volatility in the S&P 500, in the NASDAQ, in gold, in other things. And so that's a good sign. But what I'm suggesting is we just have to be a little bit, I suppose, vigilant here to, if we get to a big vol spike or something like that, to understand what to do with it. And here is exactly what I'll do with that if we do get a vol spike. And the final thing I want to wrap up on today, if I can get this spreadsheet open, is to sort of refresh for you. Let me see if I've got the right one here. What is going on in Australia in terms of the quad map? So this is an up-to-date spreadsheet with the current data that we've got for GDP, inflation, and interest rates. For Australia, it's looking like in quarter four here, we're back in quad three, but then next year shooting into quad one in the first half of the year, and quad two. Now, again, these are the good quads. This is why I'm saying and have been saying to you that in the first half of 2021, the expectation, and it's a reasonably high degree of probability, that we're going to land in quad one or quad two in quarter one, and almost certainly in quad two in quarter two. And this is going to be fantastic for Australia. We're going to really start to see things going well. It's going to be a time to own equities, to own commodities, to own tech, to own consumer discretionary, industrials, all of this stuff. And I'm starting already to position portfolios for this, what I think is going to be a great, fantastic year next year in terms of the stock market, buying Australian equities and buying exposures to those particular sectors. I'm also buying exposure to energy, and I'm buying some exposure to other things like some small caps and stuff like that. I'm going to most likely look to exit all treasury and fixed income positions except for inflation protection tips in the next couple of weeks, hopefully. See what happens with the election. But again, positioning mainly portfolios for what I think is going to be a strong run in equities through the first half of next year. And then obviously we'll just have to get some data to see what we get in terms of the third and fourth quarter of 2021. That'll probably be based upon whether there are any events or anything that happens with resurgence of COVID or some other unknown black swan type event that comes out to bite us in 2021. Let's hope not. Let's certainly hope not. So there you go. That's a market update for Monday the 26th. I think, again, at the moment with the election looming, all we can do really is just kind of sit back and relax, take stock of what's going on. I'm going to be nibbling away at building up positions. So as you can see here at the moment, we've got some of the Asian indexes dropping a little bit. This will be good for building up those positions. The reason I say that, and actually it's probably worth just showing you here a couple of other major economies. I mean, look at this. China, quad one. Now, by the time we get to the sort of second quarter of next year, that'll have to be evaluated again. Whether that happens or not, we'll see. This is the further out you go in time, the less clear things get. But certainly, China right now is doing very well. Let me just go over quickly to the U.S. The U.S. next year should be, again, in first and second quarter of next year, should be hitting the quad two metrics. So that's going to be, again, very good for a number of things, including tech and broadly based equities and high beta, all this kind of stuff. One or two others just quickly. Let me just show you something else we own. We've got Indonesia there. Again, strong, looking very strong, quad two. There's a number of economies actually that are looking very, very good. Not that one. Where is it? Sorry, guys. I don't know if South Korea was in there. Oh, yes, they're hitting quad two. Thailand was the other one. I was like, well, there we go. Again, Thailand hitting quad two. Taiwan is the other one I quickly want to hit. So quad two. Again, the theme here is emerging markets are going to benefit mightily from the U.S. dollar falling. So emerging markets always do. So anyway, that's probably enough for today to hit you with. But again, just finally, this week and early next week, we're going to see what sort of crazy dog and pony show gets thrust upon us with Trump and Biden and all the rest of it. I'll continue to do what I do every day, which is try to figure out this big game of the markets and get your money positioned accordingly to profit. But from all signs I can see at this stage, there's no reason not to be setting up for a big run in the equity markets next year. So with that, I wish you a good night and hope you are all staying warm and dry. Talk to you soon.